Hello everyone, welcome to our Egyptian online seminar group. First, keep your microphones off. Then if you have any questions, you can ask our speaker after his presentation. I have great pleasure of welcoming Professor Anup Srivastava. Anup holds the procedures Candia Research Chair at Haskayne School of Business, University of Calgary. Before joining academia, Anup worked for 14 years as a banker, consulting, and corporate executive in the East and the West Coast cities of the United States and India. Anup is one of the top accounting thought leaders in the world, and also he is the world's foremost researchers on financial reporting issues of knowledge intensive companies. He has published more than 25 articles in Harvard Business Review and the California Management Review, in addition to top-tier academic journals. Now we will start our seminar with Professor Anup.
Well, thank you, Mohammed. Thanks for inviting me. It's a great honor. I know you have brought in such stalwarts in accounting. I'm nobody compared to them, but it's good to contribute to the thought. I see diverse audience there. I see Christine out there. It's a great honor. Christine, thank you for joining. I hope we have interesting discussion. So I'm going to present a paper which is co-authored with Anil Iqbal. Anil is online. He's a bright, smart PhD student. Will be in market a couple of years from now. Shivram Rajgopal, who needs no introduction. He was a presenter a couple of weeks back, I believe. Rong Zhao, who's my colleague at University of Calgary. So I'll be talking less about the paper. It's still at a very preliminary stage. We're working on it and look forward to any feedback on the topic. I'll spend more time in defining the problem, at least from my perspective or our perspective, and potentially we can talk about solutions. Another important thing is I've looked at the audience, potential audience that Mohammed sent me. We have both academicians as well as practitioners on this seminar right now. So I'll keep that perspective in mind and spend some time in defining the problem. So I'm going to start with, let's see, how do I move my slides? Is it moving?
No?
Nope. All right, that's a problem with having, okay, perfect. Okay, now it moved. Yes, I'm using two screens. Okay, so we all know that the company is the largest market cap today. This is a $500 billion club. I want to highlight the companies that used to have the highest market cap, let's say in 1950s. And again, these names are quite recognizable. General Motors, US Steel, GE, Chrysler, so on and so forth. Names that we all very well recognize. I want to bring this point that the companies that used to have highest market cap are no longer in the group on the left-hand side. Again, some numbers, Apple, $2 trillion, Alphabet, $1.7 trillion, Microsoft, $2 trillion. In fact, if I look at FANG plus Microsoft, we're talking about $10 trillion. And there are only 2 countries in the world that have higher GDP than this market capitalization. But let's also compare this number to what used to be the market capitalization of companies that were most valuable in 1950s. And there is almost an order of magnitude difference, if not more. Huge difference. Now, you will say, what's so strange about it? That the companies keep on changing, creative destruction occurs, the companies that are most valuable are no longer the most valuable today. But here is the interesting part. Look at the key assets of a 20th century corporation and compare it to a 21st century corporation. So think of General Motors when you think of a 20th century corporation. What are the key assets of General Motors? It's land, building, warehouses, inventory, oil field for ExxonMobil, so on and so forth. And interesting part is they're all recognized as assets. And now let's come to 21st century corporation. Think of Microsoft, think of Google, not Alphabet, Google, think of Facebook. And their real assets are a unique business idea, a strategy, their peer and supplier network, their customer relationships, human capital, growth options, none of which, if internally generated, is recognized as asset on the balance sheet. So the biggest difference between what used to be most valuable in past and what are the most valuable companies today is that their assets were recognized on the balance sheet, and the newer economy, the newer companies today, their assets are not recognized on the balance sheet. Okay, and we all understand this price to book ratio, a number that has been touted quite a lot. Let's look at, and these are all today's numbers. Okay, so I'm not talking about 1950s or 60s. These are today's numbers. The price to book ratio for is to 1. When we talk about companies on the left-hand side, we are talking about price to book ratio of 15:1, market to book ratio of 15:1. That means a minuscule proportion of assets that are priced by the market are presented on the balance sheet. Now, I know market value is inclusive of many things, and we all understand that, but the difference is huge. It's not 100%, it's not 200%. You're talking about 15 times, right? So there is this research, and I've been part of this research, which talks about the declining relevance of financial statements from a financial user's perspective. So let's talk about market to book ratio. This is a paper I published in JE 2014. So the data is a little bit old, but it is still relevant. So I divide all the firms into firms that were listed before 1970, firms listed in 70s, listed in 80s, 90s, and first decade of 2000. The interesting part is that the market to book ratio has increased over time, not because of old economy firms, but because of listing of newer cohorts. So newer cohorts of listed firms have higher market to book ratio, while those folks in 50s, firms listed in 50s, 60s, 70s, or even 80s have market to book ratio pretty much close to 1:1. That means financial statements are working very well for companies that had physical assets, land, building, warehouses, etc. It's just that the newer companies like Facebook or Google's of the world book ratio that you see over time is not because of increase in market to book ratio of all companies. It is because of changing composition of listed firms. That's the point that I'm trying to make in this slide. This is a management science paper which looks at what are the firm's key operating investments. Operating investments which pertain key operating investment for companies. It is items that are reported in Sdna, which are not R&D, which are not advertising, but things like customer acquisition, customer development, brand equity, software, the data processing, so on and so forth, human capital, all of that is reported in Sdna is the firm's single largest category of investments. It's those of tangible investments. So this is how the economy has changed. Again, why is the economy changing? I looked at, in my JE paper, I looked at industries that are increasing, industries that are diminishing. Industries that are increasing are pharmaceutical, business services, healthcare, medical equipment, communication, computers, entertainment, all those that are associated with knowledge as a key asset. And on the diminishing industries are the ones that have physical assets, shipbuilding, aircraft, utilities, textiles, so on and so forth. Uh, let's look at income statement. So I talked a little bit about balance sheet. Let's look at income statement. Income statement, as we all know, is sales minus costs equals net income. Let's look at the key costs. Key operating costs are cost of goods sold and operating expenses. Typically, they are 90% of firms' total cost. COGS, cost of goods sold, that used to be firm's main cost, which is the physical cost of producing goods. That's labor, energy, machine, material, inventory, so on and so forth. That used to be firm's key cost. And then there was this category called Sdna, which was supposed to be a residual category, which is when something that does not belong to COGS used to put in Sdna. It was like a small component of firm's total cost. Again, look at firms listed in 70s, 80s, 90s, so on and so forth. Look at these firms. For these firms, cost of goods sold used to be 80% of firm's total cost. Sdna used to be 15%. With each new cohort, it is changing. And these lines have crossed over. Now think of Facebook. Facebook, what is the cost of goods sold for Facebook? Or what is the cost of goods sold for Google, its search engine business? And in fact, just to give you some concrete numbers, for Walmart, cost of goods sold is still about 75%. General Motors is still 80%. Ford is still about 80%, even though they have offloaded all of their production or manufacturing to low-cost countries. When you talk about newer economy companies, first of all, their cost of goods sold is not defined. And cost of sales is less than, it's not a significant portion. The main cost for most of them is what is called as Sdna, because it has become a catch-all for all the intangible investments. And again, if you don't believe me, these are 2020 numbers for the names that you can very well recognize. And for all of them, Sdna now exceeds cost of goods sold. Now, why is that a problem? The problem arises because the matching has totally gone for a toss. Now think of revenues minus cost of goods sold minus Sdna equals profits. If these numbers are not matched, then profit margin is a meaningless concept. So what I've shown you so far is Sdna has gone up. Now I'm going to show you that matching, there are ways by which we academicians measure matching. Matching of expenses to revenues has been declining. Each new cohort has lower matching. Old economy firms, still matching is close to perfect, 1:1. Firms listed in 70s, still 1:1. When you're talking about newer firms, we're talking about less than 40%. COGS, cost of goods sold, still perfectly matched to revenues. Sdna matching has been declining and is pretty much close to zero now. It affects what is called as relevance in accounting. It is basically to what extent is the variation in stock prices explained by variation in earnings. For the latest cohort, we are talking about 2%. So 98% variation in stock prices cannot be explained by variation in earnings. Now you'll say, why should we care about all this? In fact, we have written, Shiva Rajgopal, who's my co-author, I have written a few thought pieces in Harvard's Review. If you get a chance, you can look at it. Then the title say it all, financial statements don't work for digital companies. US financial reporting is stuck in 20th century, and so forth. Again, you'll say, why should we care? Look, it is still working well for firms listed in 60s and 70s and 80s. Well, here is the problem. The problem is that there is constant renewal of population. So if you don't understand this, you understand this part. Of all the firms listed in 2017, just 19% were listed before 1990. 80% of firms listed today were firms listed after 1990, both by number as well as by market capitalization. So what is the economy today is the financial statements are not working. So that brings us to today's topic, which is there a way by which we can improve the measurement of internally generated capital? Again, I think I'm going to talk about prior research, which shows that in-house intangible investments create future value, but not reported on balance sheet. Lev and Sojiani's classic paper, I have done some work on this. and numerous other papers. Interestingly, I want to bring this paper by Rajgopal and his colleagues, which shows that SFAS number 2, which requires expensing of R&D, was associated with the highest negative stock price reaction of all FASB standards. In fact, SFAS number 2 is the basis for expensing of all intangibles. So I think in summary, I think what I've said so far is that book values are nowhere close to economic value. However, book values are used quite often in our financial statement analysis. So whether we're talking about residual income valuation model, HML is basically market to book ratio. Value investing, if you see, I have a paper, I'm going to talk about it. Value investing is almost primarily 60% based on book value. So if you're comparing market to book and book value is totally understated, it's going to lead to problems. Think about all the financial ratios that we often calculate: Tobin skew, market to book, return on capital, whether ROE or ROA, asset turnover, debt to equity ratio, asset coverage ratio. All of these things need book value. And book value, as I said, is nowhere close to the economic value, at least as far as market prices are concerned. I wanted to highlight this paper. This is a paper with Baruch Leif, who's obviously my guru and perhaps the best thought leader on intangibles today. This paper surprisingly got a lot of prominence. Almost now we're talking about almost 10,000 downloads. And we all know that value investing is not working. It hasn't worked for the last 14 years, actually. And we said that one of the principal reasons is accounting deficiencies, because value investors typically rely on book value to take their decisions. Book values are wrong. I don't want to use the word wrong, but if they have limitations, then the investment strategies will have limitations. So what is the solution? I'm going to now narrow down to what the research that I'm going to present. But one solution for financial statement analysis is reconstruct book value. Capitalize in-house intangible investments, use perpetual inventory method. Classic example is Peters and Taylor. I have used it. Many papers have used it. The Peters and Taylor, this is a JFE paper, almost 500 citations. Many finance people are already using this method. Now, the problem with using this method is there are two problems. First problem is, okay, let's capitalize in-house intangible investments, but how do you measure intangible investments? That's the first problem. The second problem is, how do you estimate the useful lives of intangible investments? So the method is same as capitalizing, let's say, property, plant, and equipment. I'm sorry, it just keeps on, the slide keeps moving. I think it's programmed the wrong way. But anyway, the solution that is proposed by Peters and Taylor says, let's capitalize intangible investments like we capitalize Capex, like we property, plant, and equipment. But the question is, what is the intangible investments that firm make? Second thing is, what is the depreciation rate or what is the amortization rate for intangible investments? What Peter and Taylor do is they assume they go by some mechanical thumb rules. For example, they assume that 30% of Sdna is investment, irrespective of whether you're in paper industry or restaurant industry or you're in pharmaceutical industry. They also assume 100% R&D is investments, and we know that this is not true. IFRS requires firms to, let me go back. IFRS requires firms to distinguish between investment and maintenance portion. And third, they assume that the useful life of R&D or intangible investments is irrespective of industry and business model. Again, we're going to question these assumptions. So our paper is basically trying to improve a little bit on these three assumptions. Peter and Taylor, I just want to highlight, finance is using it very prominently because I think we accountants have not been able to provide a reasonable solution. Finance has taken lead, almost 500 odd. Sorry, I got disturbed by the, so almost 500 odd citations of this paper, and people have started using it. So what are we going to do? We are going to propose a new method. We are going to propose a firm year estimation of investment portion of R&D and SG&A. Second, we are going to come out with industry-specific amortization rates of capitalized assets. Again, let's emphasize our context is Peters and Taylor. Peters and Taylor are using, this is what finance is currently using. Again, I have used it, Baruch Lev and I have used this method in our own papers. Instead of using mechanical thumb rules for what portion of SDNA should be capitalized, or instead of assuming uniform lives of intangible investments, we are going to come out with a more refined method. We're going to come out with firm-year specific estimation of investment portions, and we're going to come out with industry-specific estimation of amortization rates. So what is our approach? We start with SDNA, we break it into what we call as main SDNA. This is a term I use in my management science paper. So we deduct R&D, whatever SDNA is left, we call it main SDNA. We are going to identify the portion that produces immediate benefit. We're going to call it maintenance SDNA. Sorry, let me go back to the previous slide. And whatever is left is, we're going to call it investment SDNA. Now, I know that this has problems. It could include wasteful expenditures. It could include opportunistic, it could include empire building by managers. But we show in our management science paper that whatever is left after removing maintenance SDNA, whatever is left in this indeed has properties of investments. It affects future profits and it affects future risks. So what's the approach? We are going to regress. Now I'm going to talk a little bit about econometrics, a little bit of technicalities. We're going to regress main SDNA on revenues. The portion that is attached to current revenues, we're going to call it as maintenance portion. Go back here, maintenance portion. We're going to remove it, and whatever is left, we're going to call it investment component. Again, in my management science paper, I show that indeed what is left in this regression is investment component. So that's our first step, which is to identify the investment portion in SDNA and in R&D. The second is, what is the useful life of SDNA and R&D? So we're going to use a model that has been used quite a lot, starting with Levin Sugianis. Rajiv Banker has used a lot in his papers. So what we do is we regress operating income, current operating income on lagged R&D terms and lagged SDNA. And we try to identify for each industry, what is the number of lag that maximizes the R square of this equation. So we try to find the optimal lag, and this is called unrestricted finite distribution model. Rong is on the call, I believe, and she can answer questions, if any, on this model. So we try to identify how many years do we need to go back to find that R&D still works, it still produces current profits. SDNA, 5 years back, does it still produce current profits or not? Which number of lags maximizes R square? So that gives us the lives of R&D and lives of SDNA on an industry-specific basis. So instead of assuming that R&D is going to work for 7 years or SDNA is going to work for 3 years, we identify it on an industry-specific basis. So we make two improvements to Banker et al. Model. First is we distinguish between R&D and main SDNA. Again, in my management science paper, I've shown that R&D has totally different properties compared to other intangible investments. And second, in this equation, we use only the investment portion of SDNA, investment portion of R&D, and not the total values. So those are two improvements to Banker et al. Model. Then we have identified the intangible portion. We have identified the depreciation rate. So once we know that, then we can use simple perpetual inventory model. What is simple perpetual inventory model? The capital value today is last year's value depreciated plus the new investment today. So again, to repeat, perpetual inventory, what is the capital portion? Capital portion is last year's capital to the extent it is not depreciated, and add the new investment. So we do that for R&D and we do it for SDNA. And I'm just going to present only a few slides which have numbers in it or some results because we're still working on that paper. We find that not 100% of R&D is investment in nature. It varies from 70 to 80%. Sdna, the proportion of investment in Sdna has increased over time, which is consistent with intuition. As I just mentioned, Sdna has increased, and the increase in Sdna is primarily because of increase in investment portion and not the consumption portion. Investment portion has increased, so as you can see that it has gone up from 40% to about 60% over time. Some industry statistics that I'm going to present. So this is Pharma French 48 categories, I believe. This is ordered in the ratio of market to book ratio. Pharmaceutical, almost 70% of SG&A is investment, 90% of R&D is investment. Going back here, lives, the useful lives, we capped it at 7 years and 5 years. 7 years so far for pharma, R&D produces benefits for at least 7 years. SG&A investments produce benefits for almost 5 years. Again, differing lives. So as you can see, the lives are different, and the proportion of investment portion in R&D and SG&A is different. So Peter and Taylor, the JFE paper, which assumes constant 30% or assumes equal life across industries or across business models. At least our results show that that's not true. The numbers are varying, in fact. So it goes all the way to other industries. Now, having calculated the investment portion and the useful life, we recalculate retained earnings, we recalculate book values, so book value of equity, book value of assets, and we calculate the revised profits. So earnings per share today is reported EPS, add on top the portion that we believe should have been capitalized minus the depreciation from past years. So profitability will not always increase. Profitability will increase, and modified profitability will be higher for growth firms, and for declining firms, actually, if you use our method, then profitability may even be lower. Some numbers on what do we find as modification in market to book ratio. So for pharma, for example, the reported market to book ratio is 3.6. We calculated at 2.34, and so our book value comes closer to market value. This is, again, industry-wise, some statistics. These are the only numbers that I'm going to present. So these are typically the intangible intensive industries, knowledge intensive industries. There's a decline in their market to book ratio. Some industry-wise numbers. Okay, now we have recalculated the book values. We have recalculated book value of equity, book value of assets, retained earnings. We can recalculate some of these ratios. Okay, so far I just described some methodology. We calculate these numbers, but how do we show that these numbers are superior to the reported numbers? And I would seek feedback of the participants for this, for what tests we need to perform. So we're trying to prove that the numbers that we have calculated are superior to reported numbers, or they're superior to Peters and Taylor, which use mechanical capitalization. So we use 3 tests. First is whether our calculated book value and our calculated EPS is more associated with stock price. So whether we get higher R square for this equation, and indeed we find that we outperform Peters and Taylor, and we outperform reported numbers by a wide margin. The second test we use is this Tobin skew test, investment being predicted by past Tobin skew. Now this is a JFE paper. Read that paper if you want to know the logic of this idea. Basically, they're trying to say is that can Tobin skew better predict future investments? Again, I'll not go into details of that, but all I'll say is that we outperform. And the third is, if you recall, Altman Z-score. Altman Z-score has retained earnings, it has total assets, and it uses financial numbers. We use modified financial numbers. We recalculate Altman Z-score, And see, we say, can we predict bankruptcy over the next 2 years for manufacturing firms? And again, we find that we do a better job. So what do we set out to do? What is the problem that we are trying to solve? I think we are in a very narrow area, which is financial statement analysis. Investors, analysts, lenders, they are doing a homegrown capitalization. They're using a homegrown solution like Peters and Taylor. I think we provide a better solution compared to mechanical capitalization. Second, we do contribute to the debate whether intangibles should be capitalized or not. And I think we are showing that capitalized values are more value relevant, at least in some aspects of financial statement analysis. Having said that, I also want to admit that we do not test the reliability part. We do not test the opportunistic reporting. Yes, we find that our numbers are more relevant, but does not mean that our numbers are more reliable or that it is going to improve both reliability and relevance. But definitely, our homegrown solution is better than the reported numbers. So that's all I had, Mohammed. I can take questions now.
Thank you very much, dear Professor Anup, for this an excellent presentation. Thank you very much. Thank you very much for your effort and your contribution. Now, if anyone have any questions, you can open your mic and ask your question.
Hi, I have one question. My name is Dr. Liu from Malaysia. Just want to ask for the internally generated intangible capital. Does it capture the human capital, such as their skills, their capabilities, and so on? Just a curious question.
It's a good question. Very good question. In fact, I think ideally the way one should capitalize is look at specific aspects. Like you said, in certain industries, human capital is perhaps very important, and one should estimate the value of human capital. I think what we are trying to do is I'm not saying that we have a universal solution. We are in a very narrow area. Narrow area is there a way to capitalize intangibles and come out with a value? So just to give you an idea what I'm trying to say, some training will be useful. Some training will be a wasteful expenditure. Some training will be so useful that you produce a star scientist who produces a lottery-like product. Now, based on initial investments, you cannot calculate the ex post value. All right. And that's, I think, the biggest problem. Christine is online and I'm sure she has views on that. Ex ante, how do you identify which is going to be the most successful investment, which is going to be the most favorable outcome? All right. So what we are doing is ours is an input-based method, not an output-based method. As I said, in the absence of financial reporting, finance people are creating their own homegrown solution. We are refining it. But to make your question address a bigger problem, the bigger problem is, can we identify very specific outcomes, for example, improvement in human capital or creation of a brand that turns out to be hugely successful, or creation of a pharmaceutical product that turns out to be that can cure COVID potentially. Input-based methods cannot estimate the value of the output. All right. So to answer your question, yes, to the extent that investments in human capital are included in Sdna, and we can identify them in the investment portion, then it is included. Whether it is measured perfectly or not, we make no claim of that.
Okay, thank you very much.
A question from dear Professor Christine. You can.
Thanks. You're always so sweet, Mohammed. So Anup, I put my question in the chat, but I just wanted to ask it because when I look at so let's just take pharmaceutical industry, excuse me, as an example, where the stats come out that about 90% of the R&D expenditure is investment. But then when we look at the success rate in the pharmaceutical industry, it's, at a high end, maybe 20% of drugs that they start working on eventually get through to the end and become a marketable product. And then of those, not every one of them is going to necessarily generate a lot of profitability for the company. So I'm just trying to figure out how to square that, that difference. But then it also raises another question for me, which is, have you thought about the role of impairment and how that would be or decision useful or not to an investor? So, one of the challenges, if you capitalize a whole bunch of stuff and it doesn't give rise to, a product that generates future cash flows, then you got to start taking these impairments. And we've seen from goodwill impairment that the timeliness, the reliability, the decision usefulness of those impairments is pretty questionable. So I think there's in my mind a link between those two issues as well. So I was just wondering what your thoughts were on impairment if you capitalize.
So, excellent question, and I'm nowhere the abilities of the August audience. I see some, and Christine herself is an expert on that topic. So I'm on the spot to answer that question. But you're right. For example, for pharmaceutical, 1 out of 4,000 products makes it to the market. In terms of commercial success, out of 4,000 molecules that are discovered, my wife Luminita Inake was my co-author on some of the papers. She does research on pharma, and 1 out of 4,000. So it's almost like buying a lottery ticket. Ex ante, how do you know that this lottery ticket is going to succeed and which one is not? What we are saying is that certain proportion of lottery tickets capitalized and some should be expensed. Ex ante, we don't know. Nevertheless, I think this is a question that came up quite often in my management science paper, that on average, unless firms are making entirely wasteful expenditures. So going back to, if a dollar is spent today, either it is for current benefits or for future benefits, or it is a wasteful expenditure. On average, at least proportion is with future. So again, I think a lot of things the answer is on average. It's an input-based method. If on average firms make this kind of investment, then that should be equal to the value that can be potentially created. Now, where we are coming from is, instead of using mechanical numbers, let's spend a little more thought on what proportion should be capitalized. Should it be uniform for 30% for all industries or all companies in the different stages of life cycle? So Sdna includes a lot of things. It includes normal administrative expenses, salesperson expenses, promotional expenses, so on and so forth. But the proportion of investments in Sdna differs. So I think we are giving a little more thought to it instead of saying use 30% uniform. All I'm saying is, I think we accountants haven't spent too much time because we are afraid of putting a solution. Finance guys have said, okay, if you can't provide us a solution, we are going to come out with some homegrown rules and we're going to run with it. So finance guys are running with 30%. So I think that's the first point. I think the second point that you said was, okay, it's not that firms start with bad investments. On average, they have good intentions in mind. Exposed, it turns out to be a bad investment. In fact, Shiva and I wrote a paper. It's a thought piece in Harvard Business Review, where we said, instead of clubbing everything in Sdna, why don't let's forget this categorization of cost of goods sold in Sdna and something else. Present the costs in 3 different categories. The costs that are matched to current revenues, the costs that produce current benefits or expected to produce current benefits, costs that are expected to produce future benefits. You want to call them as investments or not, but let's just present it in separate category. And the third category of costs is the cost that we spent in past that we believe will produce future value, but is not expected to create future value, and which in your terminology will be impairment. Then we further divide those 3 categories into finer categories. For example, we said, okay, if you're making investments, present that also in 3 different categories. Something that is expected to produce, that is going to benefit only existing products. Second, they are moonshot projects. Google investing in Waymo, that's a moonshot project, all right? And third is, so basically from analyst perspective, they should say, this is with a high likelihood is going to produce benefit. This is like buying a lottery ticket. So you can analyze investments. Impairments present, do describe, currently it is buried somewhere, I don't know where, but do provide which of those moonshot projects went bad, which of those improvement projects went bad, so that analysts can analyze. So to answer your question, of course, very informative. Going back to the terminology I use, maintenance versus investment portion, that's ex ante, ex post, which of those investments actually went bad. And again, within those investments, which of them were like incremental improvement and which were on moonshot projects. So I think all I'm saying is that the current categorization of cost of goods sold and Sdna, and this artificial distinction between so-called physical investments versus intangible investments. Anything that is physical should be capitalized, even though, for example, putting up all the equipment for telecom, we all know that it has very limited life. Its physical life might be 10 years, but its economic life is less than 1 or 2 years, because cell phone towers need to be updated every second or third year. So this artificial distinction between physical and intangibles, let's convert that into the framework, which is which portion is for very near-term benefits, which one is for long-term, even within long-term, moonshot versus improvements. And third is the write-offs. It was a thought piece. Obviously, to translate thought piece into concrete rules, that's your problem, that's not our problem. But that's what we thought.
There is another questions. If anyone have any questions, you can open your mic and ask your question. Question from Jay.
Hi, Anup. You already answered the first half of it. Just I was wondering the equation that you presented, like where you say that basically you employ the lag of the variables in order to see the maximum explanatory power, that's the R square. Now, do you look at the significance as well, or like how do you arrive at the conclusion that there you have to stop?
Good question, Jay. Jay is, by the way, my co-author on a finance paper. There are some few smart people in finance as well. Jay happens to be one of them. The question is as follows. So we are regressing current operating earnings on past series of Sdna and past series of R&D. By the way, both are investment portions and not the total. So the question is, so how do we identify how many lags we should take? Currently, the model we are using is which lags gives us best adjusted R square. All right. What Jay is asking is, do we even look at the coefficients? And Jay, the problem with there is, and this is when you start dealing with data, we are all medical researchers. When we start dealing with data, ideally we would have liked to see the coefficients or their significance. But often what you find is some of the signs are flipped. So it's possible that the third lag is negative and fourth lag is positive. And there's some multicollinearity going on, and we know that. So those issues have been discussed. They have been studied well in time series econometrics. I think what we are looking for is the best solution within the constraints that we have. So ideally what we should look at is even not only coefficients, but their significance. And also, in fact, the coefficient ideally should have given us an amortization structure. So if lag 1 has, let's say, coefficient of 0.3, the next one is 0.2, the next one is 0.1, it gives us some idea about amortization structure also. But when you start looking at data, it doesn't work. It's possible that lag 2 is actually minus and lag 5 is positive. Again, as I said, this is our compromise solution of using an adjusted R square.
All right, thank you.
Wani?
Yeah, hi, thanks for the opportunity. How about employee stock options? Do they allow them to be capitalized? Because in some ways, the incentive or the motivational effects are in the current period. I would love to get employee stock options for my working papers and not publications, but what's the reasoning for capitalizing or expensing? Thank you.
Shiva, are you on call?
Yes, I'm very much on call. I'm not
Okay, Shiva,
preventable.
could you take that question?
Yeah,
Shiva
I
is an
left him.
expert.
I left him an answer in the chat. So you're asking about current gap, Amin, or so if you're talking about current gap, my understanding is that it's only to the extent software can be capitalized. So a lot of the uncapitalized R&D and Sdna may very well be stock option expense. You're right.
Okay.
Is that the question?
Yes, in general, but so there's a tech industry and then there's a pharma. There must be some things in between medical devices or whatever, which like virtual medicine and so on, like boundaries between capitalizers and expensers is not, where do you draw the line? I guess it's a SIC code. Like, how do you differentiate?
No, I'm not clear about the question. You're asking about current gap or what we think it should be?
Maybe a bit of both, please. Sorry.
So current gap, as far as I know, is portion of software can be capitalized, right, voluntarily. So to the extent the company attributes the stock option expense to that portion, it's capitalized, but it's otherwise not. If you're talking about economic significance, a vast majority of stock option expense, I believe, in US income statements is not capitalized. And a lot of R&D and Sdna might simply be labor, especially higher end labor, which may all be option expense. Now there's a bigger problem. The option expense is pegged to historical quote unquote Black-Scholes. So, I'm working on some stuff where we show that if you look at the actual cash payment that goes out on account of these option expenses, it's easily 2x or 3x more. And stock options are a accrual that never gets, in a classic sense, like think about, say, allowance for doubtful debts. There's no ex post settling up with stock option expense because most companies either issue stock or buy back stock, and that goes through the balance sheet. So the market's very happy and thinks that these are repurchases. We don't go back and designate a lot of those cash flows actually as labor cost. So anyway, that's beside the issue, but I thought I'd mention that.
Thank you so much.
I mean, to the extent relevant to us, I think if it is included in Sdna, so we do capitalize a portion of that. Again, our numbers coming from that formula where if a firm spends, let's say, $100, we identify the one that produces immediate benefits. Let's say 40% produces immediate benefits. We assume that 60% will produce future benefits. It may or may not. That's the nature of investments. But if it is included in Sdna, the costs are included in Sdna, or scientist costs are included in R&D expenses, whether it is paid via cash or via paid stock options. We do try to identify a portion of that. Mohammed, go ahead.
Yeah, Sarah? Anit?
Hello.
Yes, Sarah?
Yes, hello, Professor. It's Sarah Khalid from the University of Texas, Grand Valley. Actually, I have a question regarding the equation in the management science, I believe, which regrets the revenue on the Sdna. So here, if it has an immediate effect on the revenue, so it will be considered for the current year, and if it's not, so it will consider as investment. So my question here, if it affects either the revenue for next year or 5 years after, it will be the same. All of them will be investment, and is it valuable to treat all of them as the same? Like something generate revenue for the next year and something generate revenue for 5 more years. Is it? Could we consider both of them the same, have the same effect?
So, Sarah, I think your question is, so this is the equation that you're talking about, right? We are regressing costs on revenues. And okay, so I think what you're saying is, sorry. Yeah, so I'm going to end this part, come back to, sorry, stop share. Okay, so this is a very good question. And again, I think I'm going back to the discussion I had with management science, and this is a design choice we made. So basically what you're saying is identify the portion of costs that are associated with future revenues. So instead of, so there are two ways of approaching this problem. Let's go back to the drawing board. What we say is, okay, you have spent $100 today. Let's identify the consumption portion. And whatever is left over is, we are assuming that it is investment. Okay, that's one way of approaching things. The second way of approaching things is, let's look back. Let's look at current profits and look at which past expenditures produce current benefits. So there's the difference between ex ante and ex post. Ex ante is, let's look at $100 today. Let's remove the $30 and assume that 70% is investment. Ex post is, we have realized revenues, or we have realized benefits, realized profits, and let's go back in time and see which lags produce benefits. We went for ex ante for a reason, because I think this is a point that Christine brought up. We are trying to identify which portion is investment. We all know that we are living in an uncertain economy. In fact, I didn't talk about one of my Harvard Business Review papers where we talk about the pace of creative destruction in economy has increased. The point being that ex ante, the portion that will produce future benefits, it's becoming more and more difficult to identify. Amazon doesn't know it, Pfizer doesn't know it, Facebook doesn't know it. It's becoming more and more uncertain to identify which of those lottery tickets are going to produce benefits. So we made a design choice in our paper because we wanted to make it an ex ante measure. What we are trying to identify is, starting from that $100 that you spend, which portion is investment portion. Why are we using this method? Because we are starting from the methods that are being used in finance. What finance is assuming is that if you have spent $100, then $30 has to be investment. It doesn't matter whether you're in paper industry, whether in pharmaceutical industry or restaurant industry, whether you're a startup or you're in a declining stage of your life cycle. That's what pharma is assuming. What we are saying is we're going to refine that method. So ours is an ex ante measure. And your question is very valid. Why don't we use the ex post measure? Again, depending on where we start from, the approach will differ, but we made a design choice to go with ex ante measure. And I totally understand that ex post, it may or may not produce benefits. That's the nature of this.
Thank you. I have another point, like what is left for SG&A, which will use to generate revenue in the future. It doesn't matter if it will generate revenue in the next year or 5 years later or 10 years later. You didn't differentiate between them. Like all of them will be in the same category, which is investment. There is no categorization for this investment because like money generate like revenue for the next year will not be treated as one which generate revenue in the next 10 years. So this is like
so excellent point, Sarah. So Sarah, what we are trying to do is first we are trying to identify the portion that is investment. So out of $100 that is spent, we're trying to identify which one is investment and which one is consumption. So having identified $70, now your question, we're not going to treat them as equal. So our first step is to differentiate $100 into 30 and 70. Now we have found it $70. Now we are going to use an amortization schedule. We're not assuming that $70 is same. Because remember, we are using a perpetual inventory model. Perpetual inventory model is whatever was the last year's depreciated plus the new investment. Same thing as capex. You know, what is how do you calculate property, plant, and equipment? Property, plant, and equipment is last year's value minus the depreciated value plus the new capex that you make. The same idea. So whether it produces benefits over 3 years or 5 years or 7 years, that is included in our amortization schedule. So we are using the same idea as CapEx. First, let's capitalize it.
Yes, I
And
got that.
then we are going to depreciate it, what we call as amortization. We're going to amortize it. And we're going to do it differently for R&D and differently for Sdna. And there we use that distributed lag model to identify the optimal lag. Does that answer your question?
Yes, very clear. Thank you.
Anita Hussein. Hussein.
Oh, I think Dr. Rajgopal answered it already. But so my question was actually whether the method or the adjustment you are proposing, is it applicable only for the? I mean, you're suggesting it is applicable only for the firms with high intangible assets, or just for all firms universally? This method can be a good one.
I mean, the way we are agnostic about whether a firm spends $5 or $5 million on intangible assets. So we are doing it for all the industries. The proportion that is capitalized differs by industry. So for example, mining surprisingly spends a lot on Sdna. And what is, you'll be surprised, you'll question me, why does mining spend so much on Sdna? Actually, a lot of dry hole expenses are included in Sdna. Their exploration expenses are included in Sdna. So what is investment for mining companies? They're trying to find new mines. Okay, so they have to dig hole and it may turn out to be successful or it may turn out to be bad. So they're trying to find fields and they're digging holes. All those costs are included in Sdna. So we are agnostic about whether you are in, our method is applicable to any industry, to answer your question. The proportions that we identify differ across industries. That's why I presented. For example, for pharma, almost 90% on average of R&D is investment in nature. Almost 70% of Sdna is investment in nature. For a company like utilities, we find it is very low percentage, very low portion of Sdna is actually investment. I think the refinement we are bringing is, instead of assuming a uniform 30%, give a little more thought. Okay, don't say that the proportion of investment in Sdna is same for utilities or for pharma or for restaurant industries. We are going to provide you a little better method to calculate the proportion.
Thank you.
Professor Samir Trapolsi.
Great paper, Anup, as usual. I'm going to look at your presentation from a different perspective, and Shifa kind of answered my question. Here, there is a trade-off between providing financial statements that are reliable, but somehow irrelevant because they miss the firm fundamentals, or providing some financial statements that are not that reliable, but comparable to the point that investor can make his mind. And your presentation and Shiva answer is that you go for the next, you want, maybe it will be from resource allocation, from optimal resource allocation perspective. Your talk is suggesting that we need to come out with a comparable, a tool that enable a comparable measure of intangibles.
Yes, Samit, by the way, thanks for coming for the talk, and thanks for your question. And this is the question that standard setters like Christine, they grapple with every day. If it was so simple that if something could include both relevance and reliability, they would have done it. I think this paper is not about arguing for capitalization. I think we are very cautious, and I express that caution. What we're saying is people are coming out with their homegrown solution in the absence of a solution. So let me define the problem again. The problem's definition is as follows. 90% of the firms listed today were listed after 1990. Financial reporting is not working as well for these companies as it used to work for companies like General Motors or Ford. So we know that there are issues. There are issues, but there are people who use financial numbers. Those who use financial numbers are creating their homegrown solutions. We are going to provide them with a better solution for financial statement analysis. Just to give an example, Samir, my paper with Baruch Leib, we thought it's just a 20-page paper. It's not even properly written. It's a very simple analysis written for practitioners. We are surprised to see 10,000 downloads. We're surprised to see Economist and Wall Street Journal and Bloomberg and you name it, institutional investor putting that as a headline because there is a limitation from the user's perspective. And so there is a need out there. There's a problem out there. I'm not saying that capitalization is a solution. Okay, Baruch Leib may differ. Baruch Leib is my guru. He differs on that aspect. I'm not saying this is, all we are saying is for those people who are capitalizing it on an ad hoc basis, we are providing you with a better mousetrap. Instead of using a shotgun approach, use a rifle approach. Is our rifle perfect? No. Does it solve the reliability problem? No. Opportunistic reporting? No. In fact, in my management science paper, we identify those issues. There are issues related to, so capitalization is not just opportunistic reporting, but it's also revealing private information, right? How much you are investing in new product development or on new business ideas. Companies may not like to reveal it. It's proprietary because it can be, it can lead to, giving away too much information can also lead to reduction in value of the firm because it can affect the strategy. So it's not only a reliability issue, but also proprietary information. So point well taken. And again, as I said, these are the issues that specialists like Christine grapple with all day long. All we are saying is, instead of an ad hoc method, we are providing a better mousetrap. And it works. We are demonstrating that it works.
Professor Christine?
I just wanted to build on what Anup was saying, because I think that there are approaches that work well from a valuation and investment perspective. So taking the information, analyzing it in different ways to get some insights that provide you with an opportunity to better value a company and hopefully make some money in the capital markets. That doesn't necessarily translate into, well, this is a good way to do the accounting. So, I think Anup and I agree that there is a need for financial reporting to provide more relevant information about the new economy, and that can be done in a number of ways. And that's our job. We need to do a better job of that. So disaggregation, for example, of cost of sales, Sdna, more disclosure to help put those numbers in context. Those are all things that I support us doing as a standard setter. Of course, I'm 1 vote of 7, so I'm speaking for myself. I'm not speaking for the board here. But I would argue that putting everything on balance sheet and then amortizing it on a straight line basis isn't, to my mind, the best solution to this problem. And so, I balk a little bit when I hear the solution is, let's just put all these expenses on or expenditures on balance sheet and then amortize them on a straight line basis. Personally, I think that would destroy, not improve the income statement. But I agree. I think we fundamentally agree. Anup and I fundamentally agree that there is much room for improvement in financial reporting.
And in fact, I think Shiva has typed a few things in the chat. And Shiva, you can please participate. People are, I think what Shiva is trying to say, people are doing it. And, thanks to my paper with Baruch Leib, I did talk to many investment banks, and I've been invited to give my presentation to them. And I was surprised to see the demand. Okay. Again, I think we nowadays we are all, we are all grown up, we're all tenured people. So we're trying to solve some problem. We're not just writing for the sake of publication. There is a real problem out there. The problem, it may not have been a big problem when Ruklev started raising his voice maybe in 80s or 90s, but it's a real problem. If 90% of your firms listed today are listed after 1990, analysts are trying to analyze them using financial statements, and they're still using the same. In fact, I often leave with a simple question: do the DuPont analysis for me for a company like Facebook. Okay, to me, when I teach financial statement analysis, that's what I taught at Tuck, that's what I taught at Northwestern. Financial statement DuPont analysis is one of the most important things that that is a tool that I used. And we talk about DuPont analysis, you're talking about net income by ROE, and you break into net income by sales, sales by assets, and assets by equity. And you suddenly find that all of your ratios have gone for a toss. Income statement, that income by sales, gone for a toss. Your asset turnover, which is sales by total assets, has gone for a toss. And if you don't know asset turnover, you cannot calculate the future cap requirements, and leverage, again, gone for a toss.
But
So
Anup,
there's a, yeah.
Can I just say though, what you're describing is, so the complaint about financial reporting is that financial reporting hasn't updated for the new economy. And I take that point. But what you just described is valuation analysis that has not updated for the new economy. You're still trying to use all of the same old ratios that worked when a company was primarily bricks and mortar, and use those same ratios and those same approaches. So, I think we all need to I guess, update in how we think about financial reporting for the new economy and analyzing for the new economy. And I don't think the new economy is all about the balance sheet. And I think we all need to think about, well, how better to provide that information. And I just don't think it's necessarily through focusing analysis on the balance sheet ratios or focusing financial reporting necessarily on the balance sheet.
Christina, I agree with you. In fact, as I said, I think that paper with Barukle, we were surprised to see the success, because even now, the so-called value investing is based on market to book ratios. Let's go back to, Graham's Day securities analysis, where he said, if a company has a market to book ratio more than 1.5:1, then it's overvalued. Don't buy it. If you use that, you would not have bought Facebook or Google. So I totally agree with you that tools need to be revised. Let me push you a little, since you are on the call, and I know it's my presentation, it's not your presentation, but why do you capitalize Capex then?
So there's a whole host of practical problems when you get down to the company specific trying to capitalize internally generated intangible items. Okay, so if a company is building a building, then they're pretty sure that at the end of that project, they're going to have an asset, right? There's not a lot of question. And they know the beginning of the cost accumulation period, and they know the end of it. And they can identify that those costs, those expenditures relate to that asset that they're building, okay? So now let's think about a situation where a company ultimately ends up building a very valuable customer list. Well, when they made that first sale, did they have a customer list? What about when they made the second sale, the third sale, the fourth sale, the fifth sale? At what point do they recognize that they have now an asset that they're constructing? So that's practical problem number one. Practical problem number two is that split that you're talking about between how much of that selling effort was to generate the sale today versus how much of the cost of the selling effort was to build the customer list that has a future benefit. So you have a really difficult allocation problem in real time. So I can go on, but there's just a whole host of problems. And then even if you can get around all of those problems and figure out what should go on balance sheet, well, then you've got the issue of impairment analysis, which is costly and is difficult to audit and difficult for companies to do. And we've seen that over and over again in goodwill world. You've got the problem of determining the amortization period in a way that it is not just a arbitrary allocation, because users hate arbitrary allocation. So you've got to have firm specific and asset specific if you really want to communicate meaningful information. And we know we don't do that well, even for PP&E. Everybody picks, straight line, some set period that's common across all companies, right? So now we want to sort of roll out that relatively not great accounting to, 80% of the company's expenditures. But anyway, so you've got all of those issues. So it's just from a theoretical argument, I can see the arguments, but from a practical perspective of writing standards that are implementable and not subject to abuse is a very challenging exercise. And that's why I think that the solution is not necessarily capitalization, but that's not to say that there isn't a problem that we need to find a solution to.
Yeah. Ram, you had a point I can see on your chat. Ram Gopal? I think he's left.
Hi, I'm
yeah.
here.
Go ahead, you're making some point in the chat. Yeah.
I think, we've been kind of stuck in this world of deterministic depreciation patterns. And that kind of destroys the information in depreciation itself. We have a few notable exemptions. There are areas where extraction-based industries, we do it differently based on resource extracted and so forth. But I think it'd be useful to sort of maybe consider whether capitalization and depreciation in the context of information-based depreciation based on how much of an asset's used up or what value remains, which we have as impairment in some cases, but think of it as a more continuous process, would then add more value to both capitalization and the income statement number that comes out of it. I know there are lots of really thorny practical problems in implementing those and auditing those, but that might be something that we may have to start thinking of as a profession to see what might be ways to bring that information into play. Because right now, the way I see this debate, the only thing I see is where manager decided or informed capitalization is allowed versus these kind of user developed capitalization numbers. The difference is simply one of, does the manager use their superior information to beneficially correctly capitalize the numbers, or is it opportunistic? That's the real trade-off that seems to be there. To go beyond that, I think we need to start thinking about not fixed depreciation schedules and more continuous information-based depreciation rules. And that might prove really useful, but it's a long road. And I think I take a lot of Christine's comments here, especially in terms of allocation and how to think about these processes and how to think about depreciation in that context. But I think that would be something really useful to think about, start thinking about, what might be the way to get there. We might not get there for a while, but it's worth having those discussions and at least finding a future way to get there.
Thanks, Ram. In fact, I think a little bit of that came out in our, again, I'm not talking about capitalization, but I think with Christine's point, give more information. This is our thought piece on the Shiva and I wrote in HBR, which is basically, first of all, identify what you have spent on, and ex post, identify which were wasteful, and more in terms of disclosure than capitalization versus depreciation. But I think your point is well taken. Shiva, you were talking about in the chat about people are doing it anyway. They are capitalizing it anyway. Do you want to elaborate on that? And this is again, I think what we are trying to, first of all, we have identified a problem. The problem is that the users are coming out with homegrown solutions anyway, and we're going to provide a little more refined method.
Just to add to several things, Scott made some good points that the ex-ante probability of a success for a project like this is limited, and we 100% agree. And unless disclosure improves, maybe we are simply at some level, massaging the data differently and so on. Several good points were made. We could do many more things, right? For instance, when we run that first matching regression, we assume that the R&D contributes to revenue only once, which is Christine's point as well.
Yep.
Maybe it doesn't, or maybe we can refine many of those things. But regardless of whatever we do, from a policy standpoint, unless the information changes, whether it's through capitalization and impairment/depreciation, whether it's just better disclosure like the pharma world, phase 1, phase 2, phase 3 idea, it's very hard to make progress. And in my mind, it's a very big potato. It's a very big problem, given the numbers that Anup talked about. And I worry that the regulators are running the risk of effectively not being responsive to the user community. Because if the SEC or the FASB doesn't do anything, people will come up with their own solutions, use big data, etc. So, and that's one way to do it, right? But it's very costly to the whole user community because, I don't know, bottom line, unless there is progress in regulation, I don't see much future for this.
In fact, just to give two examples, I don't know, many people, most of us still use Fama and French model, factor model. HML is a very important factor that is used. HML is negative since 2008. So it is basically saying that you take risk and your returns are negative because HML is used as a risk proxy for risk. And HML is basically, the idea comes from value investing where you're taking. So HML is based on some numbers. Now what people do, there are at least 10 papers, thanks from after my paper with Baruch, at least 15 papers out there that are trying to refine HML. When we talk about Peters and Taylor, those again, we are empirical researchers. There's a new Tobin skew measure out there, which is available on Words. Now people are using that. So there should be a demand. Otherwise, Words has not put a new Tobin skew out there. Words has put a Tobin skew, which is based on mechanical capitalization. Mechanical 30%, mechanical 5-year. All right. So as Shiva rightly said, that there is a huge demand. I mean, these are not flash in a pan companies anymore that they were perhaps in 90s. In fact, I often say FANG plus Apple is $10 trillion. That's a market cap.
Can I add to your point, Anup? I think this is the point that Baruch's made before. I'm just probably rehashing it. But by effectively doing nothing, I mean, I'm surprised the SEC hasn't pushed Amazon. That's the stuff that I left in the chat. They spent $42 billion on R&D, 300 words in the 10K. Wow, right? By not doing anything in general, we are actually promoting narratives of overvaluation. Going back to Christine's point, it is so easy for the manager to say, gap is screwed up, don't look there. Look at all the shiny objects I'm going to create in the next 50 years. There's so many examples of that. So we might actually be making the problem worse. So anyway, it's easier to spin narratives if you're a duplicitous manager.
So in fact, Shiva's point, just to elaborate, Amazon presents a huge R&D number, and it is not true research and development. A lot of content acquisition is included in R&D. So we are not just talking about numbers being underreported on investment category. We're talking about investment category. Everybody considers R&D as investment, at least. For example, Peters and Taylor, they assume 100% of R&D is investment. Going back to Levin Sugianis, 100% of R&D is investment. Now, if you start using that $40 billion as an investment number, again, you're making mistakes. So we have underreporting and we have overreporting. That $40 billion is not all R&D. A lot of it is pure engineering, a lot of it is pure content acquisition. The true R&D number is much lower. So, Mohammed?
There are other questions. If anyone have any questions, you can open your mic and ask your question.
So this is Ram again. So a while ago, when it was in the late 90s, there was a project that the SEC undertook to review all MD&As and see whether people were complying with all the information that was supposed to be in there in the discussion and analysis. And they came out with a lot of amendments that companies had to make to give more information on liquidity demands and things like that, that didn't quite give enough details based on their numbers. There was some papers by Barron and a couple of others about this at some point. But I think the key issue now is to ask, are we disclosing sufficient information about large numbers on our income statement and balance sheet? And are we giving this information in a manner in which it is actually useful? So for instance, if I had R&D numbers, I'd want to know something like how many projects are involved, what is the largest project, so what can go wrong, what is the biggest project, what are the relative sizes of the projects, maybe say over $100 million, so much, 50 to 100, so many projects and total amounts and so forth. And say something about time to fruition. When are we expecting this to all turn out? I don't know, people talk a lot about proprietary cost. I don't know how much of this actually leads to proprietary issues. Knowing this kind of information doesn't mean you can necessarily replicate that strategy. So I know that firms frequently, claim that they can't give more information due to proprietary cost, but it's useful to actually explore if data at this level, which will still produce more granular information to support estimations such as yours, and be useful to investors without an actual depreciation schedule, without facing all the other allocation problems that we talk about. I think it would be really useful to at least go down that path of disclosure and see if we can force more disclosure there, and see if we can get somewhere. So I'd love to listen to all of your views on that. Thank you.
So Ram, I think 2 points. First of all, proprietary cost, I wanted to bring somebody else's perspective, because in our management science paper, we argue for more disclosures, but we wanted to bring the other perspective, that there is a perspective about proprietary cost. About a second point, I think that's what Shiva and I wrote in our thought piece, exactly what you're talking about. In fact, Shiva and I have spent a lot of time in trying to find some very basic things. For example, how much do firms spend on their employees? How much do firms spend on marketing? I'm just giving a basic pieces of information you cannot find. I have a paper with some marketing people. We cannot get this information from disclosures. As Shiva rightly said, in fact, I gave you Sdna numbers for the most important companies today. Sdna number is bigger than cost of goods sold. You look at their Sdna disclosure. Anil, the PhD student who's there, smart PhD student on the call, he spent a lot of time in trying to figure out. He looked at the biggest Sdna numbers and he said, can I find something? And he found nothing. All that firm says is that our Sdna increased by 5% or increased by 3%, but there's absolutely no details. As Shiva pointed out, look at Amazon's R&D. In fact, Shiva has written about it, and there are some articles about it. When you go into actual, close to nothing. So we are still grappling in the dark. We are trying to find a step which is better than where we are right now. But without information, analysts are struggling. Researchers like us are struggling. I mean, we don't matter, analysts matter, but they're all struggling. And your point is very valid that some time back, we did have a project that we need to have enhanced disclosure or more informative disclosures. But practically, if you see, by the way, it's very interesting. One of the HBR articles Shiva and I wrote, we said, okay, what we are going to do is we're going to have freeway discussions with top tech analysts and CFOs of top tech companies. And we said, okay, we're just going to spend 1 hour just having a discussion about it. And I think this came up. One of the points I want to say is that, Christine, even though it's difficult to estimate the value of some of the intangible assets, many companies have set up internal mechanisms in trying to estimate their value. So for example, a very big company said that they reward their salespersons based on the value of a customer asset that they generate, because there's a customer value, lifetime value, and they pay 30% of that. So they are estimating it. Very big company, one of the largest companies, said that they do not allocate their capital based on traditional measures. They are allocating based on option value of those projects, not NPV, not discounted cash flow, but whether they have potential to generate, multi-billion-dollar. They're willing to walk away from a 300 million NPV project to potentially invest on something else, which is potentially worth 10 or $50 billion. So they have mechanisms to calculate, and they are doing their resource allocation based on that. Ram, to your point, it's just not available to investors, and so.
If I can, so I totally take the point that some companies are doing that. But you got to remember, when you write accounting standards, you force everybody to do that. And there are a lot of companies out there that aren't to that level of sophistication. They don't have that level of internal processes. And then on top of that, when you write a standard, it has to be audited. It has to be regulated. So, it's not, and I know you know this, it's not as easy as just saying, well, because, we know 1 or 2 companies or even 100 companies are doing something, that is a cost-effective solution for the marketplace. So I just want to make that point.
In fact, Shiva has raised an excellent point that, in fact, firms are acquiring intangibles. When you think of Google or think of Alphabet, actually, sorry, companies like they are basically venture capitalists. They're not pure search engine anymore, and they are paying. They're paying. So they are doing some calculations. So there is somebody is estimating values, whether it is for internal rewards or for external purchase. And ultimately market is also valuing these companies. So there is some valuation going on. The question is, whether we should, how and whether we can force managers to reveal at least part of that information. And as Shiva has also mentioned in the chat, that proprietary cost is a disguised way of promoting the agency cost, which is, managers don't want to reveal. Ram, how many projects go bad? How many managers would like to reveal that? How many managers would like to admit that they spent $100 million on a project and it went bad, or it is going bad? Mohammed, any more questions?
There is any questions? Another questions? Thank you very much, dear Professor Anup, for your contribution and your effort. It's an excellent presentation. Thank you very much. And so all that remains for me to say is thank you everyone that's joined us, and I thank you very much for taking the time out to present to us today, dear Professor Anup. It's been really appreciated. Thank you very much.
Thanks, Mohammed. Thanks for inviting us, and thanks for all the participants. I think this is one of the most important, if not the most important question in front of us. So great. Thank you.
Thank you very much.